This chart shows the February 2026 employment consensus versus reality. Markets expected a gain of 50,000 jobs. The actual result was a loss of 92,000. It is the worst monthly contraction since the 2020 lockdowns, missing the central forecast by 142,000 jobs. On the exact same morning, WTI crude oil spiked more than 6% to a 13.5-month high. WTI, or West Texas Intermediate, is the benchmark for U.S. crude oil prices. The Iran war has closed the Strait of Hormuz, cutting off a major global energy artery and guaranteeing an immediate surge in inflation. The Federal Reserve now faces contradictory mandates. Cutting interest rates to address the massive job losses will accelerate the new oil-driven inflation. Holding rates steady to fight that inflation ensures the high borrowing costs destroying employment will continue. A contracting labor market colliding directly with soaring energy prices creates a stagflation trap. The central bank cannot solve both problems at once, eliminating the standard mechanical response to an economic downturn. This dashboard shows the Economic Fragility Monitor. The overall systemic fragility score formally remains at 42.1, classifying the economy as pre-systemic. The framework requires precise threshold breaches to trigger an upgrade, preventing premature alarms. Look closely at indicator EFI6, the unemployment rate. It sits in the green zone at 4.4%, but carries an active amber watch notation. The rate has climbed 30 basis points in 4 months. At this trajectory, it will breach the 5.0% amber threshold in 3 to 4 months. The SOM rule confirms this trajectory. The SOM rule is a recession indicator that triggers when the 3-month average unemployment rate rises half a percentage point above its 12-month low. With the 12-month low at 4.0%, the current 4.4% reading puts the U.S. economy on the absolute boundary of a formal recession signal. Indicator EFI 8, the Fed funds rate, remains constrained in the red zone. The central bank cannot lower rates because it is fighting 2 simultaneous inflation shocks. Energy prices are spiking from the Middle East blockade, and the administration's 15% global tariff on imported goods took effect this week. This graph tracks indicator EFI 1, high-yield credit spreads. They have breached the warning threshold, sitting at 3.03% in amber territory. Credit markets are now pricing in both an energy inflation shock and a severe recession signal at the exact same time. When credit spreads widen under stagflation, the damage is sticky. The Federal Reserve has no room to step in and ease financial conditions. Because of this policy trap, the path from 3% to crisis levels of 4% and 5% OAS, or option-adjusted spread, a measure of credit risk premium, accelerates from a matter of months to a matter of weeks. Based on the current labor market deterioration, unemployment will hit the 5% threshold in 1 to 3 months. That specific trigger event will move the indicator to amber and raise the overall fragility score to roughly 47.6, cementing the contraction. For the corporate sector, the timeline for relief has collapsed. Businesses carrying variable rate debt must discard any refinancing models built on a July or September 2026 rate cut. The baseline assumption is now 0 rate cuts for the remainder of the year. In Australia and New Zealand, the damage transmits directly to households. Because these markets rely heavily on variable rate mortgages, an extended policy hold by the central bank immediately restricts consumer spending capacity. They face a domestic labor slowdown combined with imported inflation. The United Kingdom is severely exposed to the energy shock. The UK relies structurally on imported natural gas, and domestic storage levels are already depleted from winter. The massive spike in energy costs guarantees rapid inflation for British households, alongside the rising threat of a weakened British pound. Switzerland faces the exact opposite currency problem. Geopolitical panic and a contracting U.S. labor market drive capital directly into the Swiss franc as a safe haven. Because exports account for 70% of Swiss GDP, this rapid currency appreciation severely compresses export margins exactly as global demand drops. The U.S. stagflation trap exports its paralysis worldwide. Allied central banks are forced to halt their own stimulus plans to defend against imported energy shocks, locking global markets into the identical, contradictory bind.